Good morning, ladies and gentlemen, and welcome to the show on this Sunday, the 26th of December, 2021. Hope you guys had a good Christmas. Now we're moving toward New Year's, and I'm going to take the time today to explain to you guys how to know or a really good my indicator. I'll explain to you what it is of when we're going to experience this massive move downwards in almost all asset classes, including the stock markets. What's going to trigger it? I'm going to get right in there and I'm going to show you guys what's going to trigger it. And I'm going to explain it to you. It might take me a little while to explain it to you, but if you listen carefully, by the time I'm done, you guys will have a better understanding of what's going to trigger the event that's coming. So let's get started. Let's open up the charts right here. It all has to do with the 10-year. U.S. 10-year. 10-year Treasury bond. The 10-year Treasury bond, and the U.S. Treasury market, the debt market, is so much larger. It actually is the dog that wags the tail of the stock market. So this is the dog, and the stock market is the tail. And where this goes, in other words, the tail follows. This is what most all debt's based on, is this U.S. 10-year Treasury, including your house mortgage and everything else. Everything is based on the debt of this U.S. 10-year Treasury. And this is why we should observe it, and this is what's going to set the stock market off into a big, enormous problem. Now, what we're looking at here, we're going to examine it closely. We're looking at a chart that goes all the way back into the 1980s. This is a long-term chart of the United States 10-year Treasury. And what you see here is, going back I guess around 1981, we were looking at 14% interest on a 10-year Treasury. And what this means is people could purchase treasuries and get 14% interest on their money. So if you had $1 million, you could get $140,000 a year. You could live off of that. You could live off of your savings back in those days, back in 1982. And Paul Volcker had to get those interest rates up that high in order to suppress inflation at the time, which was actually not as bad of an inflationary period as we're having right now. And so what you can see here is you can see these yields have fallen over the years, lower and lower and lower and lower and lower. And not long ago, they were in 2020 they were down, what is it, 0.49% or something like that. It turned incredibly low at their lowest ebb here. What's it saying here? 2020, 0.65%, less than 1% interest. Well, right now they're standing at 1.49. Let's take a look at the last 5 years here. And what we're seeing they were up to 3.13, almost 3.25 they peaked at back in 2018. And I was on here on the show, and I said that if they go up too much higher, we're going to have a stock market crash. But we were in a different circumstance back then. Back then, we wouldn't have a stock market crash unless they breached like 3.5% on the U.S. 10-year. But now we're in a totally different set of circumstances right now. Now what we have is we have a market that's going to crash out of bed if the U.S. 10-year goes above 2%. You say, well, what's the difference? The difference is, between then and now, is the size of these hyper bubbles that they've been building in the economy. Real estate bubbles, tremendous real estate bubble around the world that's actually beginning to burst now in China. But that's a different story. That's because of Evergrande and the property developers. But right now, what we're looking at is mortgages have to stay low in order to keep the sales. It's like any Ponzi scheme. It gets harder and harder in the end. It's a greater fool theory. Whereas the more leverage you push into a system, the lower you have to keep yields in order to maintain that system and keep the bubbles from bursting. And so back when we had these yields of 3.2% or 3.25% back in 2018, we didn't have as much leverage in the system as we have now. These bubbles have been inflated much larger. So now we can't withstand over 2%. And you see, going back to this chart, if we take a look at the long-term chart, there was a time when we could withstand over 10%. We could withstand all the way up to 15% because the system wasn't over-leveraged. This is what they've had to do. They've had to bring these yields down lower and lower and lower and lower and lower over the years to maintain this over-leveraged system. Now, what this does is, when you look at these treasuries, you're looking at something that's inverse. It's like looking in the mirror. A lot of people think that when yields go up, that's the treasury market going up like all the other markets. But this works in reverse. When treasuries yields fall or get lower, this means that this market is doing rather well. It works in reverse. So you'd have to flip this chart upside down to see which direction it's really going. It's been going up. Even though it's been going down, this is actually, these yields have been falling. That means that there's more money coming into the treasuries. It means that the treasury yields are going up. The market's going up, I should say, not the yields. When the yields fall, it means that the treasury market's going up. It means it's booming. It means it's bull. It's a bull market when treasury yields fall, because it works in the inverse from all the other markets. It works upside down, backwards. So when treasury yields fall, it means the market's booming. They have a bull market. When treasury yields go up, it means that the market's crashing, because it works opposite from all the other markets. Now, I know this is a little bit confusing for you guys, but what you can see here is all the way back to the 1980s, this market has been in a bull market. It's an incredibly long bull market. It's never stopped. And yields went down lower and lower until they're minuscule now at this point. Now, what's the Fed doing? They're talking about taper. Well, you have to understand that the Federal Reserve is the biggest buyer of these, of treasuries in the world. They're the biggest buyer of treasuries of their own debt in the entire world. And they've been buying these treasuries and keeping this market in a bull market for the longest time. Billions of dollars every month they're buying. They're the biggest buyer. They're the big buyer. They're the ones that are keeping this in a bull market. So now the Federal Reserve is talking about taper. What does that mean? It means that they're going to start gradually pulling out of this market and not buying anymore. Well, now, look at this yield, 1.49%. Well, we understand that inflation is running hot, over 6%. And you're only going to make 1.49%? Who's going to buy this junk? You're not going to make any money on it. How can you make money if it's 1.49% and inflation's over 6%? You can't make any money. Not with these low yields. But the Fed's the biggest buyer, so we don't have to worry, because the Fed's going to be in there buying them all, even though that the yields are low. Well, guess what? What the tapering means is that the Fed's pulling out. They're pulling the plug. They're going to stop buying. But not all at once. They're going to stop buying gradually over the next few months. So what's going to happen? Well, it's obvious that these yields, these incredibly historically low yields, we take a look a little bit closer here at this 10-year, that this should start to creep up. And in fact, we've already seen it creep up somewhat. It's been creeping up from the lows of under 1%. Now it's 1.49. How much can the markets take before the markets roll over? We've got to watch this debt market. Well, I'm going to tell you, I've been figuring it probably someplace in excess of 2% on the U.S. 10-year, and we're going to see the market start to roll over. But we're pretty much safe, I think, until we get up higher than 1.75. I think the markets are fairly safe right now as long as we're below 1.75. So as we move into the new year in January, I'm not really anticipating these markets to roll over quite yet because I think this U.S. Treasury 10-year yield will still be under 1.75. On our channel here, we're going to be watching this very carefully because this is one of my main indicators of when we're going to see markets start to roll over. Is when this breaches 1.75 in the U.S. 10-year and starts to approach 2%. Let's see. I haven't looked it up. I think the first big cut, was $30 billion they're cutting off of purchases of these treasuries. Is the first cut, and then the next cut will be, I think, another 30 billion and so on. I think they got it all figured out for. I think by the time the first quarter is over, they're going to be down to zilch. They're not going to be buying anymore. Well, if they're not buying anymore, we should see these yields breach 2% on the U.S. 10-year. And before the first quarter's over. And this is why I've been telling you guys, you got to be awful careful on all asset classes. I don't think this is going to transfer quite as badly into gold and silver. And gold and silver is going to hold their own a little bit better. For one reason is we saw 70% gains on Bitcoin last year. 70% up. What did we see on gold? It went down all year. What did we see on silver? It went down massively. I think it's like 16% on silver down. Bitcoin and the cryptocurrencies are more of a speculative asset at this stage in the game. They haven't made the transfer over to being a store of value like gold and silver, and so even gold and silver might go down some when we get this bearish action that's coming, caused by the Fed. And so we got to watch these U.S. 10-year Treasury yield. Remember, 1.75%. We're probably safe until we get to 1.75%. And it's probably going to go up reasonably fast once it starts to go up. And it's not going to be long from now either. We don't have to wait long for this to happen. We're probably going to see the effects starting in January. I don't think we're going to get through the first quarter before everything starts to turn downwards. And this is not going to last long, guys. When things start to turn downwards, it's going to put a tremendous amount of pressure on the central banks. And it's going to break them. Because it's going to continue its downward trend until they go back to a more normal-headed policy. You see, let's go back on this and let's take a look at the all again, and let's take a look back when these interest rates, Paul Volcker had them up over 15% on the U.S. 10-year. Right? Think about that for a minute. They had the ability to stop the 70s style inflation, which was probably very similar, maybe not quite as severe as the inflation we have right now, by raising interest rates all the way up to 15%. Do you think we can raise these rates up now? What have I been talking about all morning on my show? I've been saying, listen, guys, they cannot get it over 2.5% on the U.S. 10-year. So how is that going to stop inflation if rates are at historical lows? And just them raising these rates a minuscule amount is going to trigger a stock market crash that they're not going to be able to stop until they submit and go back to easy monetary policy. Well, what happens then when the Fed goes back to easy monetary policy after we have this crash? Well, then it's game over for the dollar. And this is all going to happen rather quickly. The Fed's not going to be proven wrong. They can sit there and they can talk the talk, and they can start to actually walk the walk, and they can start to actually uh, pull out of the market of being the only buyer of treasuries, an only big buyer of treasuries. They can do all that, yeah, and they're going to. And they're not going to be proven wrong until they're proven wrong and until they create a crisis. After they create that crisis, then they're going to have to go back to easy monetary policy. And at this point, once they're proven wrong, and we already see the inflation trouncing in, this is going to increase the speed of the inflation exponentially in the world. Once the Fed's proven wrong that they can't tighten and stuff. Right now, they're just buying time. They're treading water, trying to convince us all that they can go through with this tightening process. And this is the only thing giving the dollar strength right now and keeping the markets, keeping stability in the system. Once it's proven that they cannot maintain this stability and they cannot stop from the money printer, they have to keep going back and creating more of these monetary units and more. It goes back to shows, guys, that I did years ago. And I said that what investors are missing when you buy gold and silver, or you buy cryptos, or you buy something like that, there's limited quantities. But what the investors are missing that invest in the dollar is, they're missing the fact that the central banks can create as many of those monetary units as there are leaves on the trees. And what are they worth then? An absolute big fat zero. And right now they're just trying to hold this system together a bit longer by impressing the world that they can balance their books, that they can tighten and stop this monetary madness. And it's not going to be proven that they can't until it's proven that they can't. And that proof's going to be coming very, very soon. And this is why we're watching the U.S. Treasury market, because this is our key. Because when they start to really tighten and cut back on these purchases, and in fact, they're planning on raising the overnight rate, the federal funds rate, at a certain point. I think after they're done their tightening schedule, they're not going to get that far. I forecast a few shows ago that I didn't think that they were going to get much further than the first few cuts. The first cut, maybe the second cut of cutting their bond purchases before we're going to see these yields start to go up. I don't think they're going to spike upwards, but I think they're going to start moving up. We're going to have more up days in these treasury yields than we have down days as they move toward this marker of 1.75, as they creep toward that. And once they pass that 1.75, then we're in for the markets to start to react to what's going on. Okay, guys, I wanted to explain that to you guys. I hope you guys are having a Merry Christmas, and New Year's is coming real soon. And we'll see you guys in the next show. You guys have a great day. Bye-bye.